Welcome back to the studio, Frank. It's June 2016, and we're wondering your opinion on whether you think the current gold price rally is sustainable long term.
Yeah, I think there's some great research that talks about these cycles that we go through in gold. And one of the biggest cycles is almost like a 4-year presidential election cycle. How much they rally, they correct. And historically, the corrections on average have been 45% over 4 years. So we go back to the peak of September 2011, December of this past year, almost like December the 17th was a 45% decline and 4 years. So now we seem to be going through that rally, and there's other economic factors driving it, such as negative real interest rates.
Do you think gold is being fairly valued by the market currently?
Yes, I think it recalibrates so quickly. That's the amazing part about it. Gold is the fourth most liquid asset class in the world. The dollar is one. It is fourth. And this is recalibration on negative interest rates. So whenever a country's currency, and what that means is that for investors, if the government floats a government bond for 5 years and is paying 2%, and inflation in that country is 3%, that means it's a negative 100 basis points return on your money. So gold will go up in that country's currency. Whenever you want to see gold down, you have to have plus 200 basis points over the CPI number. So when gold hit the bottom, it was 200 basis points. And fascinating to me, in September of 2011, when gold peaked at 1900, the 10-year government bond was minus 3%. So it's important for investors to look at that, and what the thoughts are is that maybe by this fourth quarter we could have inflation running at 4% in the US, and there's no way they're going to raise interest rates to 6%, so we're going to have bigger negative rates of return, and gold rallies to $1,500.
When the gold price fell from $1,900 4 years ago, were you one of those who thought the price was manipulated?
I don't believe it's manipulated. What I did miss is because all interest rates were zero. So what you have to take a look, it's called a nominal interest rate, the Fed funds rate. When it's zero, you miss what the real interest rates are. And money moves around for the highest real rate of return. So we went from minus 3% to plus 2%. All the emerging markets fell, gold fell, and now we're having this reverse taking place.
In your opinion, what factors should investors consider before buying a gold stock?
Well, first of all, I always advocate a 5% into bullion or beautiful 24-karat gold jewelry, and then 5% into quality gold stocks. And when it comes to the big caps, I've always been very strong and leaning on royalty companies because they have high operating margins, they decline less, they've had better performance over the past 5 years. In fact, the Franco-Nevadas have doubled, whereas most gold stocks are still down 30 to 40% from their peaks.
Can you tell us what gold stocks you like at this time and why?
Well, I think the bigger part is to look for those companies that have high cash flow returns on invested capital. That's what's really important. So I still advocate Royal Gold, Silver Wheaton, Franco-Nevada as your core positions. And then you can turn around and take a look at some of the other sort of mid caps. And if you had another big cap, would be probably Agnico Eagle.
Well, as always, it's great to see you, Frank. Thanks so much for coming by today.
Great to be with you.